Today on the Blockchain Report, Bitcoin sitting at 105K and Bitwise says war in the Middle East could send it to 140. JPMorgan files for JP-MDB, which sounds like Jamie Dimon's new doctor show where the cure is always the blockchain. And mining one Bitcoin now costs over 70 grand because apparently your power bill now identifies as a luxury asset. All this and more on today's show. Let's go! Good morning, my Satoshi soldiers and tokenized degens. I'm Hank Hudson, broadcasting to you live from the Bay Area where the fog is free, but everything else costs gas fees, and your barista has a Substack on decentralized identity. It's Tuesday, the markets are confused, the regulators are caffeinated, and somewhere out there, Jamie Dimon is filing a blockchain trademark while calling Bitcoin a scam. Because consistency is for fiat. But before we jack into today's dystopia of finance and vibes, smash that like button like it's a MetaMask pop-up asking for the 12th time if you really want to sign that transaction. And make sure you're following RoxomTV and me at Hank at RoxomTV on whatever platform still lets you say inflation hedge without triggering a community guidelines violation. Now, whether you're tuning in from a Solana validator, in your mom's garage, a Discord where everyone's a founder but no one has a product, or a co-working space that thinks it's a metaverse hub, pour yourself a cup of that morning elixir, update your VPN, and let's figure out what the hell happened while you were sleeping and the crypto market was panic buying Taiwan invasion rumors. But first, let's check the tape in this morning's market rundown. Let's go. Alrighty, there we go. We're on the right camera. Okay, wakey, eggs and bakey. Let's see how things are moving and shaky this morning. Right now, Bitcoin dropping just below 105K. Today is a big day. We should be getting some announcements from the feds regarding some possible rate cuts. If that goes the way we're hoping today, could get really fun really fast, but we'll stay tuned on that. Next, we have Ethereum. Drawn back down, sitting right above 2,500. It's been kind of doing this dance for a while now. It sits down at 25, goes up to 28, comes back again. It looks like we're in the bottom half of that dance right now. XRP is down about 2% this morning, sitting at right beneath 219 a coin. Cardano was down 2%, and Dogecoin doing a whole lot of nothing, right beneath 17 cents a coin as of now. In the stock market, things are looking about the same. A lot of red on the board today. Not big red, but little red. Right now, the Dow Jones is sitting at about 42,471. The NASDAQ Composites down around 19,600. The S&P is sitting at just above 6,000 bucks. MicroStrategy down a little bit today, a little over 2.5 percentage points, down about 10 bucks on the whole, sitting at 372. Tesla also not feeling great today, down 2%. Coinbase also down about 1.5%. Nvidia sitting at 144, and GameStop still hurting from the end of last week at about $23.50 a share. We're going to take a quick break, but once we're back, we're heading over to this morning's bull run with the top stories in the morning, so stay put. We'll see you in just a sec.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
All right, welcome back to this morning's bull run. We go over the top stories in the morning, starting off with the military conflict in the Middle East is heating up, and markets are nervous. And Bitwise, well, they're bullish. According to Bitwise Europe, history says that war equals a bit of a Bitcoin pump. Their research shows that Bitcoin climbs an average of 31% in the 50 days following major geopolitical risk events. They've crunched the numbers on 20 global shock moments since 2010, and Bitcoin's median return was over 10% during these time periods. So if you're wondering whether it's time to buy the dip, Bitwise is basically screaming yes. And now at Bitcoin's current price of around 105K, that kind of move would take us to around 140 by mid-August. But how, you ask? Well, there are three reasons actually. First, behavior. Past geopolitical scares in Russia, Crimea, US, Iran, etc. caused initial sell-offs followed by strong rebounds. The second thing are macro factors, right? We're talking about the dollar is weakening. Inflation data came in soft. Unemployment's ticking up. And now rate cuts are back on the table. That's total catnip for Bitcoin. And third, demand. Spot Bitcoin ETFs took in $1.37 billion last week. Michael Saylor and Strategy bought another 10,100 Bitcoin. Metaplanet is hoarding coins like it's a doomsday prepper. Meanwhile, whales quietly pulled over 169,000 BTC off of exchanges. That's 14.6% of supply all locked up. Tight supply. With rising demand and the dollar's bleeding, with a little bit of global chaos slipped into the mix, and Bitwise calls it a textbook bull setup. Now, some skeptics will point out that this time it might be different. I mean, there's no COVID-level stimulus coming our way, and $55 million in realized losses hit the chain just last week. But with macro tailwinds, ETF flows, and Saylor on a shopping spree, you'd be forgiven for thinking 140K sounds anything but inevitable. And, we got some news. Yeah, what is it? Fold is. Oh, okay. What camera am I? Okay, I'm going to stay on camera one here.
Yep.
So Fold, let's take a look here what it says here. Fold Holdings, which is the parent company behind the Fold Bitcoin wallet and rewards app, has just secured a $250 million equity purchase to facilitate and significantly expand its Bitcoin treasury holdings. Okay, now the agreement allows Fold to sell newly issued shares on an as-needed basis to fund BTC acquisitions, although no Bitcoin has been purchased yet on their SEC filing. It looks like right now Fold currently holds over 1,400 Bitcoin worth like 157 mil, and this move positions it alongside firms like Strategy, 21 Capital, and Nakamoto as another corporate player turning its stock into a leveraged bet on Bitcoin's price. So, this breaking news, gang, why does this matter? It looks like, is my camera all out of focus there? It looks like the camera's got beer goggles on. I probably look way better than normal. Well, while I'm looking so good, let's go over why this whole Fold thing matters, right? So, nobody throws around $250 million unless they think Bitcoin's going up, right? So basically, Fold is saying, yeah, we want to be the next Michael Saylor. And if they follow through, that is a ton of Bitcoin coming off the market. And even if they haven't bought it yet, the intent alone certainly adds fuel to the fire, right? I mean, it's another sign that corporate America isn't tiptoeing around Bitcoin anymore. They are diving in head first. I mean, less coins on exchanges, gang, means more coins on balance sheets, and that usually ends one way, with Bitcoin go up. That's like my favorite sentence in the English language. So that's our breaking news for you, Fold. Check them out. So in other news, if you were wondering how fast markets can react to a vague post on Truth Social, the answer is immediately. President Trump bailed on the G7 summit in Canada to return to the White House. The reason being, well, a rapidly escalating Israel-Iran conflict. In fact, Trump posted everyone should immediately evacuate Tehran, which is not the kind of thing that markets usually like to hear. Within hours of the report, it was confirmed that Trump summoned the National Security Council to the Situation Room, so you know it was serious, and Bitcoin instantly fell by over 2%. From an intraday high of over 108K down to 106 at the time of writing. I mean, Ethereum nearly dropped 5% itself. Altcoins bled hard, many of which were down 5 to 6%. Roughly $400 million in total liquidations and $80 billion erased from total crypto market cap. Bitcoin is still holding around six figures though, but just barely. Right now it's around 105K. Evacuation warnings are flying in from embassies across the globe. China and Russia are urging citizens to leave Israel immediately. So yeah, we're in one of those moments where Bitcoin is supposed to be a safe haven, but sometimes it acts more like a teenager in a haunted house. Now, this isn't a breakdown in fundamentals. It's a bit of a, let's call it a panic flinch, all right? And Bitwise might argue that this is in the front end of the 50-day rally we just talked about. But for now, volatility is definitely back, and Bitcoin's reminding everyone it can still throw a tantrum when the world feels like getting a little weird. And speaking of weird, remember when Justin Sun was being investigated by US authorities? Like, actually couldn't enter the country? Well, fast forward to now, and he's taking his crypto company public in the United States. And guess who's helping? None other than Eric Trump. Because, of course, he is. Now, Tron, that blockchain you forgot was still a thing, is merging with SRM Entertainment, a NASDAQ-listed company that used to sell theme park merch. Now, they're pivoting into crypto, naturally. SRM says it raised $100 million to buy TRX tokens, and the deal could be worth up to $210 million. Now, the company will be renamed Tron Inc. because branding is hard. The deal was brokered by Dominary Securities, an investment bank headquartered in Trump Tower, featuring Donald Trump Jr. and Eric Trump on its board. So yes, this is still very much real life. Since Trump's re-election, Justin Sun has been busy buying $75 million of the Trump family meme coin, Trump. Then he dropped another 16 mil on it to win a dinner with the president, which seems totally legal. That's crypto meets Game of Thrones if I've ever seen it. If Game of Thrones had less dragons and more gold Android phones, of course. Eric Trump is expected to take a formal position at the newly renamed Tron Inc. because when your resume includes reality show real estate guy's son, naturally you get to help run a crypto company. Oh, in case you were wondering, the SEC paused its investigation into Sun's businesses right after he started investing in Trump World. Total coincidence there. I mean, we're not saying this helps Bitcoin, but it does help Bitcoin look like the adult in the room. And according to new data from the Miner Mag, the median cost to mine one single Bitcoin is now above $70K, which is up from $64,000 just last quarter and way up from the $52,000 that was the quarter before that. But why? Well, it's higher hash rates and, energy prices that apparently think that they too are Bitcoin. Electricity costs spiked nearly 100% year over year, and that's bad news for inefficient mining rigs. But with Bitcoin hovering around 105K, there's still some room for profit, but barely. Now keep in mind that 70K doesn't include rig depreciation or other costs associated with mining. In fact, some miners might already be underwater. Meanwhile, smart operators are slashing their fleet hash cost, basically trying to get more hash for less cash. Public miners like TeraWulf and BitDeer saw costs spike 25%, but others, well, they are adapting. Iron, REN stock is up over 21% in the past month. Core Scientific, Bit Digital, Cipher Mining, all posting double-digit gains themselves. But Canaan and Bitfarms, well, they're down more than 21%. The lesson here is that investors want miners who aren't just miners anymore. They want diversification. I mean, we're talking AI hosting, high-performance computing, maybe a side hustle selling LED lights on Etsy, I don't know. But the bottom line is the cost to secure the Bitcoin network is going up. But the price is going up even faster, which means that the fundamentals here, they remain strong. Hash rate equals up, security is up, price is up, Bitcoin still king. And JPMorgan Chase, the bank that hates Bitcoin but loves pretending it invented the blockchain, has filed for a new trademark, JP-MD, which sounds less like a crypto project and more like a spin-off of a Law & Order episode starring Jamie Dimon as a blockchain detective. There he is. I'm tuning in for that. But make no mistake here, gang, this filing suggests that JP Morgan is making moves in crypto, okay? The trademark application includes digital asset trading, exchange, transfer, clearing, and payment processing, which if you squint hard enough sounds a lot like a stablecoin platform. Of course, the word stablecoin isn't actually in the filing itself because that would be a little too honest, but context matters. So back in May, the Wall Street Journal reported that JP Morgan, Bank of America, and Wells Fargo were considering launching a joint stablecoin. Now JP Morgan files for JP-MD. The coincidence is convenient, to say the least. I mean, the banks reportedly want to compete directly with Tether and Circle and offer faster cross-border payments, because nothing says innovation like mega banks co-opting the thing they've been trying to regulate out of existence. Let's not forget, mind you, that JP Morgan already has a private stablecoin, JPM Coin. It's been used on Connexi platform to process over 1.5 trillion in blockchain-based payments. It's pegged to the dollar, the pound, or the euro, so it's basically TradFi with a blockchain costume. Meanwhile, Jamie Dimon continues to slam Bitcoin every time he's near a microphone, but he sure does love that blockchain, especially when he gets to name it after himself. And now enter JP-MD, an all-purpose crypto payment tool that'll probably be powered by innovation, driven by trust, and custodied by the same people who brought you the 2008 financial crisis. Also notable is that this filing drops the same week the Senate advanced the good old Genius Act, a bipartisan stablecoin bill. It passed cloture 68-30, putting it on the path to full debate and possibly a signature from President Trump himself. So yeah, the pieces are certainly lining up. Stablecoin regulation is a go. JP Morgan, they're filing trademarks, and Dimon's pretending that this isn't total hypocrisy. And Bitcoin, it's still standing, still decentralized, and still not JPM branded. So we're going to take a quick break, but when we're back, Walmart and Amazon are flirting with stablecoins? Okay, that and other news in just a sec. All right, welcome back to more of this morning's bull run. Philippe Lafont, founder of Coatue Management and professional late adopter, has emerged from the shadows yet again to say Bitcoin's volatility is down, and that is a good thing. You don't say, Philippe. Now, after ignoring Bitcoin for years because it was too volatile, Lafont now says it belongs in every modern portfolio. Why? Well, because it's growing up. No more wild price swings, no more panic selling. Now it acts like a big boy asset. In fact, in 2022, Bitcoin fell 60%, while the NASDAQ dropped 33%. This year, Trump announced new tariffs. NASDAQ fell 6%, Bitcoin down only 5%. Less whiplash, more respectability. And Lafont says that the shift means big investors are finally treating Bitcoin like a long-term play and not a meme stock. His hedge fund has already backed Dune Analytics, Hut 8, and other crypto-adjacent firms. So yeah, he's in now. And yeah, he regrets about not being in sooner. In fact, he says he literally wakes up at 3 a.m. thinking, I'm an idiot. Join the club, Philippe. We have t-shirts. Do we have the t-shirt there? I think I made one for us. Well, we'll get them. They'll be on the merch shop. There it is. Now, he also noted that more Bitcoin holders are holding longer than ever before. I mean, we're talking no more sell-offs after just a month. People are actually sitting on their bags like grown-ups. Even better, he points to BlackRock entering the chat as a sign that Bitcoin is moving from degenerate speculation to Wall Street darling. Now, Lafont thinks that if beta keeps dropping, Bitcoin gets more and more attractive to the institutional crowd, because once volatility dies down, the excuses die with it. Bitcoin is no longer too risky, it's actually too obvious. And those who missed it, they'll keep waking up at 3 a.m. And in today's episode of Who Doesn't Want to Print Their Own Money, retail monsters Walmart and Amazon are reportedly exploring their own USD-backed stablecoins because nothing screams financial revolution like a coin you can use to buy Q-tips and pool noodles. According to the Wall Street Journal, both companies are kicking the tires on launching brand-specific stablecoins, which is corporate speak for we realized we process billions of dollars and would like to stop sharing that with banks. Banks. Let's look at the numbers here for a second, shall we? So Amazon pulled in $638 billion in revenue just last year, okay? Walmart cleared over $100 billion in e-commerce alone. And your bank probably still charges you $3.95 to transfer funds between checking and savings. Stablecoins, of course, offer faster, cheaper transactions, and for companies this big, cutting out the banking middlemen could save billions of dollars in fees. That, my friends, that's not innovation. That's vertical integration with a blockchain wrapper. Now, to be clear, neither company has confirmed this publicly, but if you're Amazon or Walmart and Shopify is already integrating USDC this year, you don't want to be the last retail empire using 1997 payment rails. There is a catch, though, and it, of course, is called the Genius Act. We're talking about it again. It's that same stablecoin legislation currently working its way through Congress like it's trying to find parking on Capitol Hill. It will be heading toward a full vote and possibly into law, assuming no one filibusters it into the next century. Now, the bill itself would create actual rules for how stablecoins have to be backed, how they're issued, and get this, make them comply with anti-money laundering laws. So yes, your Walmart bucks might soon need KYC, just what the metaverse ordered, right? But don't be fooled here, okay? This isn't about decentralization. This is about control. Control over payments, control over data, and maybe eventually control over how and where you spend your digital value. Because if Amazon and Walmart launch their own stablecoins, it's not about replacing the dollar. It's about replacing Visa and MasterCard, then slowly replacing you with an algorithm that knows your shoe size and political leanings. Meanwhile, financial giants like JPMorgan, Wells Fargo, Citi, and Bank of America are reportedly also chatting about launching a joint stablecoin because nothing screams decentralized future quite like the same four banks from 2008 making a coin together. Great. And yet in the corner of the room, there sits Bitcoin still doing its thing. No CEOs to deal with, no shopping cart, no Prime Day, just a fixed supply, censorship resistant, and the slow, steady erosion of trust in the systems these giants are scrambling to reinvent, but never to disrupt. So if every company makes its own stablecoin, you don't get financial freedom, you get digital Chuck E. Cheese tokens with different logos. And we already have the real thing, gang, and it is called Bitcoin. And we talked to him about it a second ago, but Shopify, the e-commerce engine powering everything from side hustles to seven-figure drop shipping empires, is officially letting merchants accept USDC on Coinbase's base network, which means one thing. Your yoga mat startup can now take stablecoins. Welcome to the future. It's grand. Now, this new integration announced just last Thursday lets a limited group of Shopify merchants start accepting USDC payments as soon as June 12th. So what is today, the 16th? So that's like last week. Yeah, 16th, yeah. So with broader rollout plan for later in this year. So if you're thinking, wait, I thought Shopify was already crypto friendly, you're not wrong. But now it's official. On-chain and running on Base, Coinbase's Ethereum Layer 2 that promises speed, scale, and less gas paying than Taco Bell. Gross. So what does this actually mean? Well, for one, merchants get paid in local currency with no foreign transaction fees. Buyers, they get 1% cash back if they pay in USDC, a feature coming later this year, which will be great for the 5 people currently trying to earn cash back while paying in stablecoins. And most importantly, all of it's powered by a new open source smart contract-based payment protocol built by Shopify and Coinbase. So yeah, they basically built a new Stripe, but with smart contracts. So now, crypto-native checkout flows support things like delayed capture, tax calculation, refunds, and hopefully fewer "where's my order" DMs from people who don't understand how blockchain works. Now, to Shopify's credit, they chose Base for its low fees, high speed, and secure transaction environment. Or in other words, we looked at Ethereum mainnet and said, nah. And if you're wondering why all these stablecoin integrations are happening right now, it's not exactly a coincidence. Stablecoin usage is exploding. I mean, it's up over 54% year over year, with everyone from PayPal to Grab now integrating digital dollars into payments and remittances. The timing also conveniently aligns with the whole Genius Act, the bipartisan bill crawling through Congress that would finally tell the world how to legally issue a stablecoin here in the United States. So while Meta, Amazon, Walmart, and your cousin's favorite NFT marketplace are all scheming their stablecoin launches, Shopify is all like, let's skip the politics and plug in what's already working. And honestly, respect. But let's be clear here, gang. This isn't a crypto revolution. This is corporate efficiency with a USDC wrapper. No censorship resistance, no fixed supply, no decentralization. But still, it is a step. Because if merchants can start bypassing credit card middlemen with faster, cheaper, crypto-native rails, that's good for the entire ecosystem. And once they're comfortable with stablecoins, it's only a matter of time before they start asking the real question, why not Bitcoin? And in the latest twist of what even is crypto anymore, Coinbase just announced it's launching its very first credit card, and it's not some weird Web3 cashback, NFT minting, gasless wallet and a token kind of card. No, it's launching on the American Express network. Yeah, that American Express, you know them, the one your dad used to flex at steakhouses back in the early 2000s. Things were better then. The card is called the Coinbase One card, offering up to 4% Bitcoin back on every purchase. And before you ask, yes, this is a credit card, not a prepaid card, not a debit card, and not a connect to your MetaMask and hope for the best type of card. I hate those ones. It's issued by First Electronic Bank, offered by Cardless, and looks like a multi-brand partnership Frankenstein built to appease fintech Twitter. But hey, Bitcoin rewards are Bitcoin rewards, baby. And the announcement came during Coinbase's State of Crypto conference, where execs from Coinbase and Amex took the stage to tell us where we're entering a bold new era, where you can finally earn digital gold for buying iced coffee and almond milk. American Express SVP Will Stredwick said, "We see real potential in the combination of Coinbase and crypto with the powerful backing of American Express," which is corporate speak for "we missed the first 15 years of crypto and would now like to profit from it. Thank you." The card will be exclusive to Coinbase One members in the US, which is Coinbase's paid subscription tier that gives you things like zero trading fees and presumably beta access to all future Web3 cloud tokens. The waitlist is now open at Coinbase's website, and more details will be released this fall, because nothing says cutting-edge innovation quite like a product reveal that ends in check back later. Now let's talk about the strategy of all this, shall we? Amex isn't doing this out of crypto FOMO. They're doing this because they want a seat at the table. Luke Gebb, who's the executive vice president of Amex Digital Labs, which sounds like a cool name for a synthwave cover band, he said, "We see crypto and blockchain as part of the evolving financial infrastructure. Or in other words, we've accepted that this isn't going away, so we're going to pretend like we liked it all along." Their focus? Practical, compliant use cases, which is code for "we'll let you earn Bitcoin, but don't think for a second we're letting you self-custody it without 14 disclaimers and a risk assessment." Still, this is a pretty big move, because Amex has traditionally been the most buttoned-up, white-glove, airport lounge, legacy finance brand of the entire bunch. And now they're helping you earn Bitcoin for buying jeans on Afterpay. So is this the future of crypto rewards? Maybe. Or maybe it's the gateway drug that gets normies earning sats before they start asking why Amex still charges a 2.9% transaction fee on a centralized ledger. One thing about this, though, is certainly for sure. If the most legacy of TradFi giants are now printing cards that give you Bitcoin every time you tap, the line between old money and sound money is officially blurred. And another one has bitten the dust. We're talking about Mercury Fintech Holding, a New York-based digital finance firm, as they have announced that they are raising $800 million to build their own Bitcoin treasury reserve. Because apparently, the new corporate flex isn't owning real estate, it's owning sats. So according to their official press release, the money will be used to acquire and hold Bitcoin in what they describe as a full pivot from traditional treasury management to a blockchain-aligned model. That means saying goodbye to dusty old T-bills and hello to tokenized yield machines and cold storage wallets. They'll be storing the Bitcoin using institutional-grade custody infrastructure, which is kind of a fancy way of saying they won't be keeping it on Coinbase and hoping for the best. They also plan to integrate staking services and tokenized treasury tools. Or in other words, they're trying to make their Bitcoin work for them. Because when in doubt, slap some yield on it and hope TradFi gets jealous. Now, this is more than just a vanity stash of digital gold, mind you. This move is part of Mercury's broader play to reshape its financial operations from the ground up, modernizing their balance sheet while preparing for the inevitable collapse of vibes-based fiat. Also, as a side effect, the company is moving up in the world. Literally. They're graduating from the Russell Microcap Index and ascending to the Russell 2000 and 3000, which means bigger spotlight, more institutional eyeballs, and the potential for MFH stock to stop being the financial equivalent of an indie garage band. Now, in a statement that would make Michael Saylor proud, Mercury CEO Shi Ku said, "We're building this Bitcoin treasury reserve based on our belief that Bitcoin will become an essential component of the future financial infrastructure." Or in other words, we see where this is going and we're getting our chips in now. And if you're thinking, wait a second, aren't more companies doing this lately? You are not wrong. Public companies are stacking Bitcoin like it's oxygen in a blackout. Over 117 companies now hold over their own BTC balance, according to Binance Research, for a total of over 800 Bitcoin. And that list includes GameStop, yes, very much still alive. Paris Saint-Germain Football Club, because why wouldn't they? Trump Media, with a cool $2.5 billion Bitcoin initiative of their own, and Metaplanet, which is Japan's answer to MicroStrategy, and now aggressively buying the dip with the enthusiasm of a kid at a candy store who just got paid in yen. Even Ethereum's getting some treasury love recently, with companies like SharpLink dropping $425 million into ETH, advised by none other than Consensus co-founder Joseph Lubin. But Bitcoin remains the North Star. Whether it's being stacked by US companies, Japanese corporations, or now Mercury Fintech, the signal here, gang, is very clear. Bitcoin is moving from speculative asset to balance sheet essential. And when the firms you've never heard of start locking up supply before the ones that you have catch on, that, my friends, is bullish. And also like a little terrifying, for anyone still hanging out on the sidelines. So we're going to take a quick break. When we're back, we're talking about that. Thailand is going tax-free on crypto gains. Should we all move there? Maybe. We'll tell you more about it when we return in just a sec. Stay tuned. All right, welcome back. It's time for some blockchain without borders, where we figure out what else is going on in the world. It's a big world out there. And right now, the land of Thailand, the place of Pad Thai, Muay Thai, and White Lotus Season 3 has officially nuked capital gains taxes on crypto. Yes, 0% tax on Bitcoin and digital asset profits made through investment tokens. And if that sentence made you do a double take, same, bro. The move is part of a broader effort to turn Thailand into a fintech-friendly innovation hub. And it looks like they've finally figured out that taxing innovation into the ground isn't great for innovation. The Thai cabinet approved the measure this week to support entrepreneurs and startups. It removes both personal income tax and value-added tax on profits from investment tokens, which is kind of a fancy way of saying if you earn crypto gains through these blockchain-based fundraising tokens, the government isn't taking a bite. The Ministry of Finance expects this to help Thai companies raise over $3.7 billion in the near future, which isn't too bad for a country that just decided to not punish success. Now compare that with the United States, where crypto taxes are still murky, misaligned, and sometimes feel like we were written by someone who thinks Ethereum is a gasoline brand. Now, Thailand's not new to the crypto game either. Their Securities and Exchange Commission has been issuing licenses to digital asset firms, including exchanges, custodians, since 2018. And this new move positions them as a regional player ready to scoop up capital, talent, and blockchain innovation, all while Western nations bicker over what is or isn't a security. So what does this actually mean for Bitcoin? Well, it doesn't exactly directly affect the price, at least not in the short term, but moves like this, they matter because they signal a growing global trend, which is friendly regulation equals bullish migration. Now, builders, investors, and capital tend to go where they're treated best. And right now, Thailand's rolling out the welcome mat, while the IRS sharpens its pitchforks. So you might want to keep an eye on Southeast Asia. They're not trying to fight the future, they're trying to profit from it, which, let's be honest, is a lot more rational than anything happening in DC right now. All right, we're taking a quick break. When we're back, we're going to a scam alert because we have hackers using a new tactic on X that you are going to want to know about so you don't end up being a cautionary tale. Stay tuned. We'll be right there. Uh-oh, you guys know what that means. It's time for Scam Alert, where we go over the top scams of the day so you don't become a cautionary tale like the rest. And if you've ever clicked on a sketchy X link promising you free airdrops, congratulations. As DJ Khaled would say, you just played yourself. Now, hackers have figured out that the fastest way to steal your crypto is to dress up like someone you trust. Here's how it works. Now, they either hijack verified accounts or spin up near identical lookalikes of popular crypto brands or influencers. Then they tweet out fake airdrops, limited time giveaways, or token launches that all lead to one place, a wallet draining disaster. You click that link, you connect your wallet, sign a contract, and poof, your funds tend to vanish faster than a Solana validator during downtime. Now, take the Sonic airdrop scam on May 29th, for example. Looked legit, posted on X, turned out to be a honeypot for anyone dumb enough to click. Same deal happened with the ZK Sync account in May of 2025, straight up compromised. And let's not forget that time both the NBA and NASCAR's official X accounts got hacked. This was back in March, mind you. Suddenly, they were launching an NBA and NASCAR coins, which, to be fair, still sound more promising than 90% of what's on Coinbase right now. Then there was the journalist from Wired who got his X account hijacked. The attackers launched a meme coin on pump.fun, rugged it, and made off with around 10 grand in under 20 minutes. Now, one Telegram user was noted as he demanded a $2,800 refund, issuing a series of racial slurs and threats in the process. Great. Then there's Pump.Fun's own account. Yep, they got hacked too. The scammers first launched a fake token called Pump, then followed it up with another called GPT 4.5, which, let's be honest, sounds like a failed Google product. The hackers even threatened to delete Pump.Fun's account if a scam token didn't hit a $100 million market cap. Bold move for someone hiding behind a VPN and eating Cheetos in their mom's basement. But even the Trump family wasn't safe from all this, as in September, Laura and Tiffany Trump's accounts were both breached. Scammers promoted a fake crypto project called World Liberty Financial. Eric Trump had to jump on X to clarify that the whole thing was a scam, which might be the most relatable thing he's ever done. So how do you not get wrecked from all this? Well, it's not that hard. Just stop clicking on everything like it's 2011 and you're trying to win a free iPad. So here's your noob-proof checklist. Take notes, okay? First, check the URL. If it says Binance.com or ends in LOL, maybe don't click it. Watch the tone. If it's screaming only 30 minutes left in all caps, it's not airdrop FOMO, it's definitely a trap. Look at the actual account, right? Seems like simple enough, because if it's got a paid for check mark and then suddenly pivoted from posting dog pics to launching a token, don't trust it. And is the engagement weird? If the comments look like a bot farm, like "this worked!" exclamation point, "thank you!" exclamation point, "I got rich," etc., etc. Run. And always double check wallet prompts. One wrong signature and your assets are gone. And use two-factor authentication here, people. Seriously, it's 2025. If you're not using 2FA, you deserve the phishing email from Elon Musk 420 at Gmail. And for the love of Satoshi, separate your wallets. One for daily degenerate activities, one for long-term storage. It's called compartmentalization, people. Look it up. And lastly, report and mute. Help kill scam visibility so we can all scroll in peace, please. In crypto, your biggest enemy isn't volatility. It's your own curiosity and poor judgment. So next time you see free ETH drop, connect wallet now. Just remember, the only thing you're going to drop is your net worth if you click on that link. All right, we're rolling into bullish, bearish, or BS. Let's hit the stinger and do it. We don't got a lot of time. All right. We're just going to roll. There we go. Beautiful. All right, first up, bullish, bearish. We go over the top stories of the day and say if they're good, bad, or indifferent for Bitcoin. First, we have Bitwise says that Bitcoin tends to surge after major geopolitical shocks, saying 31% average gains in 50 days post-crisis with escalating conflict in the Middle East. It looks like we could be seeing this very soon as well. It's a clear trifecta: chaos, macro tailwinds, and massive demand, all bullish catalysts for Bitcoin's price. So I'm bullish on that to start. Next, we have Thailand just eliminated capital gains and VAT taxes on crypto investment tokens. Come on, guys, super bullish on this. I mean, regulatory clarity and tax relief in Asia draws capital and devs, and it's good for global adoption and long-term Bitcoin demand. I'm bullish on that too. Bullish to start. Love it. Next, we have Jamie Dimon's favorite blockchain side hustle now has a name. It's JP-MD. The trademark includes crypto trading, payment processing, and all the TradFi turned Web3 buzzwords you could ever imagine. I'm calling BS on this one. This isn't innovation. It's banks doing PR work, and Jamie Dimon traditionally still isn't a big Bitcoin guy. I'm calling BS on this. Next, we have Bitcoin mining now costs over $70K per mined BTC, but Bitcoin's still hovering around 105K, so the network remains secure and profitable for now. I'm calling this bullish. I mean, rising costs squeeze weak miners out. It also hardens the network and strengthens long-term price support, so I'm bullish on that. And last, we have Eric Trump. He is helping out with Tron going public. He's taking a new role as the newly renamed Tron Inc. because nothing says trusted crypto leader like reality TV and theme park merch. This is BS. This doesn't help Bitcoin. It helps Bitcoin look better by comparison. So today's final score, 3 bullish, 2 BS, 0 bearish. So today's diagnosis is bullish. I mean, the chaos is bullish. Global regulation is trending in the right direction, and Bitcoin's holding steady above 100K, even with war headlines and mining costs spiking. The fundamentals are tightening, the demand is growing, and the nonsense is making Bitcoin, there it is, looking more legitimate by the hour. Long term, Bitcoin is still king, baby. As always, thanks for tuning in to the Blockchain Report. Be sure to like, follow, and subscribe to RoxomTV and me at Hank at RoxomTV on all platforms, and I'll see you all Wednesday for more crypto chaos. Enjoy your Tuesday, everybody.